top of the hour, so I'll go ahead and hit record and say good morning to everybody, and thank you so much for joining this presentation about the Hillwood 403B plan. Now, I really like giving this kind of presentation because I think it's a really good reset. A dozen reasons why it's going to have a reset when it comes to the retirement plan. Namely, so a lot of people
We can't hear you. I'm sorry.
Can you hear me now?
Yes, and I'm sorry, Keith.
No problem. I called in. Usually my AirPods are better audio, but I just got hung up on. Anyways, were you able to hear all that up until the 20 seconds ago? None of it.
Up until 20 seconds ago, yes.
Oh, okay, gotcha. So sorry about that. But in any events, you can get to that point where it can be set it and forget it as long as you answer 4 questions before doing so. Over the next 30 minutes, I'm going to go over exactly what those 4 questions are and how somebody might answer them. But a big theme of this presentation is if you are thinking that you're not sure what's right for you, you want to have a deeper conversation, you have a question that doesn't apply, or you don't think would apply to the rest of the group, you're going to see our contact information both at the start and the end. I really want to encourage everybody to use us. We're just simply here as a resource. If you give us a call or shoot us an email, the person on the other side is a certified financial planner such as myself, right? Somebody who has the experience and expertise needed to help with everything from building a budget and getting out of debt all the way up to creating an income in retirement and giving myself a paycheck. But if you do have any questions along the way that are a little bit more applicable to say everybody, maybe it's more of a yes or no question, please go right ahead and answer, or ask them rather. You can do so one of 2 ways, either in the chat box or in the Q&A feature, making sure that everybody can chat. Yep, everybody can now. And I'll get to them along the presentation. If there's anything that I miss, I'll certainly answer at the end. And I'll be hanging out for any additional questions as well. So diving into it, one more time, my name is Keith Huber. I'm a certified financial planner and an investment advisor with the team being One Digital. And if you had any questions for me directly, you can reach me at keith.huber@onedigital.com. Now, if you haven't heard of us before, we are the retirement plan advisor for Hillwood. Now, that means we do a bunch of things, but at the core of our services, we give advice. Now, we work with both leadership at Hillwood, talking about what's working with the retirement plan, what's not working, and making changes as needed. But we also, of course, as you can tell by the presentation today, we work with the employees where we do give advice. Now, that advice can come in the form of webinars such as this. We do a dozen others throughout the year through newsletters that we put out. But certainly, again, what we find to be the most valued service is the one-on-one financial coaching sessions that we offer to all the employees. Just to reiterate, those are complimentary and they're confidential. And really, there's no question too small. I hadn't used this before today, but I just started messing around with Chat GPT over the weekend. Maybe kind of think of us as that for your retirement plan questions. One other thing to mention is where you see our presence the most, if you don't take us up on any of those services I just mentioned, is we, along with leadership at Hillwood, are the ones who are selecting and monitoring all the investments that are available to you in the retirement plan. Now, you might be thinking to yourself, wait, I thought my retirement plan was through Vanguard. And you're absolutely right if you were thinking that. There are 2 companies that work with the retirement plan. So 2 completely separate and independent companies, but we work together because we're working towards the same goal of providing what we feel to be a best-in-class retirement benefit to all the employees. The cleanest way to draw a line and to differentiate between the 2 is if you have questions about what to do in your retirement plan, reach out to us. Right? Again, we give advice. If you have questions about how to do it, reach out to Vanguard. So a great example might be, I'm not sure if I should go from 6% to 7% contribution, or pre-tax to Roth, or investment X to investment Y. Reach out to One Digital. We could talk through your unique needs and circumstances. If you already know you want to go from 6 to 7 or pre-tax to Roth or investment X to investment Y, you're just having trouble doing it online, you can always reach out to Vanguard and they can make those changes for you over the phone if you did not want to use the online feature. So for today, for the retirement plan, I mentioned there's 4 questions that everybody needs to answer. It doesn't matter if you're new to the retirement plan or you've been in it for 30 years. It's they're all still equally as important, and they're in no particular order. So they are: how much should I contribute to the retirement plan? A lot of people will confuse the term match with max because you can certainly contribute more than you're matched on. How should I contribute? Because I can do so one of 2 ways: pre-tax and or Roth. I can do both at the same time. How should I invest my money? Right, once it's in the retirement plan, what happens to it? And then who's my beneficiary? Now, the last one is not something I can give you, or that I'll give you any commentary on who you choose, but I will certainly remind you for the 403B or any other account that you have out there, or any life insurance policy, that it's very, very important to not only make sure that you have one, but to also make sure that it's updated and it reflects who today you would want to receive your assets, God forbid something were to happen to you. Something to keep in mind with your 403B beneficiary: it legally has to be your spouse if you're married, unless they sign a spousal consent form. If you're not, you can put whomever you'd like. And we always encourage folks to put both a primary and a secondary beneficiary. In the very slim chance, hopefully, that something were to happen to you and the primary beneficiary at the same time. All right, so contributing to the retirement. Now, I speak to a lot of people one-on-one, and you can imagine I get a lot of questions, but the most common one is, should I contribute more to the retirement plan? And the answer is, of course, yes. Of course, we all should contribute more to the retirement plan, right? We're doing so in a tax-advantaged way. We're only going to set ourselves up better for the future, all good stuff. But then naturally, the next question is, can I contribute more to the retirement plan? Which is where things get a little bit more interesting. Because at any point in our career, there's going to be competing priorities, whether we're young and new to the workforce, and maybe we're on an entry-level salary, maybe we have student loans that we're paying off, maybe we're just figuring out all the bills that need to be paid when we're now living on our own, whatever it might be. So towards the middle of our career, it's things like saving for a house, maybe our kids' college, and then for so many people, it's not until the end of their career, until they're on the proverbial doorstep of retirement, till they can actually choose, or excuse me, they can actually put all their time and effort and resources into saving for retirement. So there are a couple of goals along the way. Now, to evidence the fact that you can put even more when you're on the doorstep of retirement, the IRS actually gives you a catch-up contribution allowance. So for 2023, if I'm under the age of 50, I can contribute up to $22,500 into the retirement plan. That's just my money, no employer money. And then if I'm over the age of 50, I can do an additional $7,500 for a total of $30,000. Right? It's again just the IRS recognizing that some people might need to catch up for not contributing throughout their entirety of their career. Now, if you're just getting started, we really, really, really encourage people to get to 3% at the very least. Right? Because you have a very generous 100% match, dollar for dollar, on your contributions up to 3%. Meaning if I'm doing 3% and I'm eligible to receive the match, I'm getting 100% return on my money, and I haven't even invested it yet. It's an incredibly powerful thing, something very generous from your employer to offer that we really, really encourage everybody to take advantage of. If you don't, you're really leaving free compensation on the table. So that's goal number 1, right? For some people, you might stop there. And if you're at least getting that match, you're only contributing 3%, but you're getting 6% going into the retirement plan. But as we continue to increase our contribution rate, the second goal is to get to somewhere between 10 to 15% of our pay. Now, again, at any point in your career, that might seem like a lot to ask for. It might seem like a tall task. But this is only to say that if I could do that from age 21 to 65, I should be in pretty good shape. If I'm not quite there yet, there's certainly no reason to be discouraged. It's just something to strive for. One way that people do that is by automatically increasing their contribution rate. People will set that up to say every January to increase their contribution rate by just 1%. I say just 1% because what I know from talking to so many people is if you set it up to automatically happen, then when January rolls around, chances are you won't even notice the extra 1% coming out of your retirement plan. Now, it doesn't necessarily have to be January. I say that because oftentimes that's when people might get a raise, a bonus, a cost of living adjustment, or they've just gone through the holidays and now all of a sudden expenses are a little bit lower than they were the previous couple of months. Here's a statement we probably have all heard as it pertains to our investments in general, but the more we save and the earlier we do it, the more money we're going to have at retirement. But sometimes I think it helps a little bit more to put numbers on that principle. So this is showing the principle of compounding interest. 3 different people. The difference is just simply when they save. So when they're doing $500 a month or $6,000 a year. To focus on the first 2 first, that first line is somebody who starts out hot out of the gate. Don't ask me why, but from age 20 to 30, they're able to do it. They're saving $6,000 a year, $500 a month. But for whatever reason, at 30, they stop. Just don't contribute another dime, but their money stays invested for the next 35 years. They accumulate $918,000 in this example. Now, the second person, maybe they're dealing with student loans. Maybe they were on an entry-level salary where they didn't feel like they could meet their current needs and also save for retirement. But to make up for it, they contribute the next 35 years, 25 years more, right? $6,000 a year, 25 years. They're contributing an additional $150,000 out of pocket, but they don't amass the same balance as the person who started a little bit earlier. But of course, what we hope everybody does is that third person who contributes the entirety of their working career. Now, this is by no means a way to say that if you're past the age of 30, that you're behind or it's too late or anything like that. It's just this encouragement to put as much away as you can as early as you can. I'm the first person to say, and you might call me the 403B guy, right? But I'm the first person to say that for everybody, retirement's not the only thing that we want to do. They're saving for a house, they're saving for our kids, saving for a big trip, whatever it might be. There always could be a reason, a good one, why we're not saving for retirement. There also can always be a bad reason why we're not, but certainly something to keep in mind. You're not behind. It's just more so encouragement to do what we can. Why is there's such a big disparity between the first 2 people? It's the principle of compounding interest, which is essentially the idea that our money earns interest, which earns interest, which earns interest, and so on and so forth. So to give you an example, if I have $100 today, and over the next year, I earn 10%, I've earned $10 and I have $110. If over the next year, I earn another 10%, I've now earned $11 and I have $121. Now, that doesn't sound huge, right? The benefit is that $1 extra in that example, but we got to remember, we're not saving $100 for retirement. Maybe we're doing that every month. Maybe we're doing that every paycheck. And that compounding isn't happening annually. It's happening every single day that we stay invested. And then to illustrate a point that I made before about increasing our contribution rates, here you see the difference of somebody who stayed stagnant at 3% a year. That's the Navy individual, and somebody who increases their contribution rate again by just 0.5% each year. You can see they amass an account balance about 3 times that of the person who stays static there. And that's increasing each year up until they reach the IRS maximums. So really powerful thing, a really nice feature that you could turn on through Vanguard. All right, assuming there are no questions, but again, please go right ahead and ask them. That's how much, right? How much to contribute. 3%, really everybody should think of as the floor. There might be a reason why you can't get there today, but if we at all can, let's really strive to do that. And then 10 to 15% being the ultimate goal for the entirety of a career. But then it comes to how should I contribute? Now, pre-tax can also be called traditional. It's not usually called traditional in the 401k, but if you're familiar with IRAs, something outside of your employer, a lot of people might have a traditional IRA. So for the sake of the taxation, which is what we're talking about here, they can be used interchangeably, pre-tax or traditional. But nobody really says, hey, you just saved $20 by contributing pre-tax to your retirement plan. But in reality, that's what's actually going on. So I just have an example to show just that. This is somebody who's making $35,000 a year, paid every 2 weeks. And the assumption is that they're in a 20% tax bracket, Fed, state, local. Now, if they were to contribute 10%, just to call out that number, they have $135 going into the retirement plan every paycheck. What's actually coming out of their take-home pay is $108. In other words, if I were to take that money as income, put it in my bank account, pay taxes on it, instead, I would have $108 to spend. The disparity, the $27 or so, is again what I would have paid in taxes. So that's that upfront tax advantage at work. Now, I already alluded to it, I can contribute one of two ways, pre-tax or Roth. So traditional or pre-tax, again, they're synonymous in this sense. As you just saw, the money goes in before I pay taxes. I get an upfront tax advantage. And then however long it stays in my retirement plan, I still don't pay taxes on it. And when it comes out in retirement, I just pay whatever my ordinary tax rate is at that time, right? I'm giving myself a paycheck in retirement. Now, Roth and as after tax, so the money goes in after I've paid taxes, but the trade-off is it grows tax-free and distributions in retirement come out tax-free. So do I pay my taxes today or in the future? Well, ultimately it's a bet. And it's a bet on what your tax rate is today versus what it's going to be in the future. And we simply cannot know, what that's going to amount to. Some aspects of it, we have a little bit of control over, right? As I said, you're giving yourself a paycheck in retirement. So we have some control over our income. But maybe a really big factor that we may or may not know today is where we're going to live. I'm sure, like many on this call, well, I live in Maryland, like I'm sure many on this call do, and we pay state and local taxes. If I somehow knew I was going to move to Florida or Texas or Wyoming or Tennessee in retirement, then I know right off the bat, I'm getting a state and local tax deduction right there. But of course, the big thing that we have no control over and nobody can accurately say where it's going to go for the next 50 years is what is the federal government going to do with tax rates. So ultimately, it's going to have both. It's another form of diversification. It is tax diversification. Now, you can make an argument at any age, any income, any amount in the retirement plan, why you might do one over the other. But the one pretty clear-cut time where most people will agree you should do one over the other is when you're younger and newer to the workforce. Now, the idea there is if I'm 25, I'm hopefully in a lower tax bracket than I plan to be at 35 or 45 or 55. Now, that might sound surprising that I said 25 versus 45 instead of 65 or 85, right? And it's not a bet on, am I going to be in a lower tax bracket at 25 versus retirement? Again, maybe that's a good bet, but who really knows? It's impossible to predict tax rates 40, 50 years in the future. So instead, what I know is that I want to have both, right? I want to have that diversification. So it's instead a bet on, is my tax rate lower at 25 versus 45? And if I continue to progress through my career, if I start making more money, if we always have a progressive tax bracket, then I'm probably going to end up paying more in taxes later on in my career. Meaning it's probably a good bet to do Roth younger. What are some other considerations though? First, that employer contribution that you receive is pre-tax. So if I contributed 3% Roth, I'm being matched 3% pre-tax, and I automatically have both amounts of money going into my retirement plan. Something else to mention, I've already said it a couple of times, but you can do both. If you want to contribute 6% as an example, you can do 3 and 3, 4 and 2, 1 and 5, whatever breakdown makes the most sense. I will say rarely is it a situation where if you calculate it to the dollar, you can say, all right, I'm doing 10%, but it's going to make a lot of sense to do 7% Roth, 3% pre-tax, right? That's usually isn't that clean cut. If you want to do both, most people will just split it down the middle. Am I maxing out my retirement plan? So I already mentioned the limits, right? They are 22,500 or 30,000 over the age of 50. Let's just say I'm doing 22,500 and I'm doing so pre-tax. If I'm still looking for more ways to save, and I've already done, I've exhausted options that are outside of the retirement plan, then I might consider incorporating Roth. And here's how that might look. If I'm doing 22,500 pre-tax, then the actual impact on my take-home pay is something like $18,000, right? Because I'm not paying taxes on the money. Now, if I switch, and let's just say for illustrative purposes, I did 100% of that Roth, now I'm paying $25,000, $26,000, $27,000 to put $22,500 into my retirement plan. So I'm not contributing more by doing Roth, but I'm paying more to get a more valuable dollar into the retirement plan. We already talked about where will I live in retirement. That could be a really big factor if I already know if I'm moving from a state income tax state to one that doesn't have it, or vice versa. I expect my income to increase. Also really talked about that one. If I think it will go up in the future, might make sense to do Roth today, probably pre-tax in the future. Impact on my take-home pay today. This is really relevant if I am contributing 3%. Let's just say do 3% pre-tax, and I feel like that's all I can contribute right now. Probably want to keep it like that. Don't want to incorporate Roth today, because that's going to mean more coming out of your take-home pay. And it's much more important to get that generous match, that 100% return on your contribution, as opposed to incorporating both pre-tax and Roth. And then finally, I get this so often. I think this is the most common misconception as it pertains to your Roth 401k. There are no income limits. There are income limits to contribute to a Roth IRA, but they're not to contribute Roth to a 401k plan. All right, and I'll wait a second to see if there are any questions about that before I move on. All right, so we talked about how much, right? 3% or 10 to 15% is the secondary goal. How to contribute, right? Pre-tax and or Roth. But what happens when it's actually in the retirement plan? Well, we just need to be acutely aware of our asset allocation, right? A fancy word. All it's talking about is our combination of different investments, our ratio of stocks to bonds to cash. Now, this might serve as a review for some, but just to set the stage for what they are, they're ordered from left to right, from least risky to most risky. So short-term investments are cash. They're usually something that your bank's going to offer you. Money markets, treasuries, CDs, they carry their most risk. And I've been talking about this for years, but it's really topical in the past 12 months from inflation, right? If inflation is 8% and my money's growing at 3%, then I'm making more money, but I'm losing purchasing power, meaning the money that I'm making is not going as far. So that's where most of its risk comes from, because it's so low risk, it doesn't offer much in terms of return. Now, a little bit more riskier bonds, also called fixed income. They're IOUs, they're issued by governments and corporations. They have the potential to pay interest. They're more risky than cash or short-term investments, and thus have a higher potential for return, but they're not quite as risky as actually owning a company, which is really what owning stocks or equity represents. They have the greatest potential for growth, but also the greatest potential for volatility. Look no further than the past 3 years rather, and 3 months to see that on full display. Now, a word we probably have all heard as it pertains to our investments: diversification. It's spreading out our bets. A really great way to do so is through mutual funds. And those are the investments that are available in your 403B plan. They're collections of investments, right? Instead of being able to invest in Amazon or Apple directly, you can purchase the S&P 500, which has Amazon and Apple and 498 or so other companies as well. And why do we diversify? So if this might make your eyes go cross if you try to read all of them. You don't have to read any of them. I still think you'll get the kind of the theme, the flavor of this. From left to right, you're seeing the past decade in market performance. From top to bottom, you're seeing the highest performing sector of the market to the lowest performing sector of the market. So if you pick any color and you follow it from left to right, with maybe one exception, you'll see that nothing is consistently at the top nor consistently at the bottom. The bottom row for much of the 2010s, it was commodities and cash were not a really great place to be. But look at last year. That was the place to be. You're either in commodities, had your money just in cash, or you lost money, right? That's just the reality of 2022. Now, when we diversify, what we seek to accomplish is that neon yellow balanced index that cuts across the middle. It helps to participate in the upside of the market while helping to protect us from the downside of the market, right? And that is diversification. Now, how do we do that in the 403B? Well, as we are part of that team that's selecting all the investments, you can imagine we have a very intimate understanding of what's available. And there are 12 stock mutual funds, 5 bond mutual funds, 1 stable value or money market fund. This is our cash offering, and then 12 target date investments. If you want more information on all those investments, you can find probably more than you'd want by just going onto the Vanguard website. You can see a ton of information about all the investments that are available. Now, I'm going to really harp on target date funds for just a minute because they are by far and away the most popular investment that's out there, not just with the Hillwood retirement plan, not just with our clients, but across the country. About 75% of people choose them for their retirement plan. The reason being is that they make it so easy for investors. They're a one-stop shop, set it and forget an investment that you can choose today and really not have to think about until retirement, because they're complete portfolios in themselves. They have stocks and bonds and cash, and they're fully diversified like we just talked about. But the most important thing that they do is they get less risky as you get closer to actually needing the money. So how might that look for somebody who's born in 1980, as an example? If you're born in 1980, the 5-year increment, because the investments in the retirement plan go by 5-year increments. They're Vanguard Target Retirement, 2020, 2025, 2030, all the way up to 2070, if you can believe it, are all available in the retirement plan because people who were born in the year 2005 are now entering the workforce. So each and every one of them, complete portfolio in itself. You typically choose, unless you, excuse me, I'm fighting a sneeze. You typically choose, unless you have a reason to believe it's not an accurate age or year, the 5-year increment closest to when you turn 65. So somebody born in 1980 might choose the Vanguard Target Retirement 2045 investment. 65 years after they're born is the simple math. Now, if you're somebody who thinks that they're going to retire later, 70 or 75, or always considers themselves more aggressive than their peers, you can always choose a 2050 or 2055 fund. Conversely, if you think you're going to retire sooner, or you want to be more conservative, you can always choose a 2040 or 2035. The secret about these investments is all of them, all 12 of them, have the exact same underlying investments. So you buy this one investment and it buys the same thousands of investments. It's just varying proportions based off how close you are to actually needing the money. And here's how that looks. The blue shaded portion is stocks. The silver is bonds being less risky, as we just discussed, right? And when you're 45, 40, 35, 30 years away from retirement, you're in 90, 95% stock, right? You're going to see higher highs and lower lows, but the idea is the higher highs eventually beat out the lower lows. And that's okay to see more ups and downs, larger swings in our account when we're that far away from retirement. We don't need this money tomorrow, right? And we want to take on a little bit more risk because it has historically meant higher expectation for return. And again, a secret is if you're 30 or 35 years away from retirement, you probably don't need to be invested all too differently. But once you get there, again, 20, 25, 30 years away, the professional investment manager, in this case at Vanguard, begins this process of de-risking. Fancy word, all it's talking about is selling off stocks and replacing them with bonds as you get closer to needing the money up to retirement, that vertical white line, and even through retirement where you stay invested. Now, for somebody who wants to take a more hands-on approach, that's why those other investments are there. The 12 stock mutual funds, 5 bond mutual funds, and that one cash option If you want to take a more hands-on approach, certainly reach out to our team. If you want a second opinion on what you're doing, or just to discuss how we might go about it. A lot of people naturally want to make that conversation about, well, what's going to make me more money? I would tell you right now, if I knew that answer. Instead, I see it as just simply a question of how involved do I want to be. The vast majority of people say not really, and that's where the target date funds come in. They're a really great option for the set it and forget it investor. The DIY investor might be somebody who really enjoys investing. They monitor the markets. They, as an example, maybe they think that over the next 12 months that international is going to outperform domestic, or small cap outperform large cap, and they want their portfolio to be positioned as such, right? For that individual, we feel that we've given them all the tools to create that portfolio themselves. And then finally, before I finish up, one more reminder about beneficiaries. Something that I think surprises a lot of people is that whoever you list on your 401k or 403b rather, actually trumps anybody you might have in a will. So if you have your retirement plan through Vanguard, you listed it through Vanguard going to person X, but in your will it's going to person Y, then you and you were to pass away, it's going to go to person X. So really, really important just to make sure that those are coordinated. Finally, I'll just leave everybody with our contact information. And like I said, I'll stay on to see if there are any questions. Please go right ahead and ask them. But if not, thank you all so much for giving me some time this morning. And if any of your colleagues missed this, it is recorded. So, please let them know that they can catch the recording as well on demand. But if not, thanks again and have a wonderful rest of your day.